Now, hopefully you've already watched the video on how to understand the basic workings of the income statement for a period of time, generally a quarter, which was revenues, and we subtracted our expenses, and we had our profits. And hopefully you've already looked at the one that we called the balance sheet, that sheet that must balance, which was basically looking at all my assets and how they equal liabilities plus equity. And of course, all our current assets were here, and our long-term assets were here, and our current liabilities and our long-term liabilities were here. We do it from liquidity measurement. And we discussed the fact that when we get profits, we retain them here on the owner's equity for use in further growth and purchasing of assets that will generate our revenues. Now let's talk about another statement I'm going to refer to as the cash flow statement. I'm going to break it into three parts. Well, we have three parts. The first part I'm going to call cash flow from operations, the cash flow from investing, and the cash flow from financing. Now, some people think this is probably the most important of all the statements. It's probably the least understood, I know that. And basically what it's trying to do is it's taking your accrued method of accounting through rules referred to as the generally accepted accounting principles and bringing it back to its cash basis, because as we know it, we need cash to sustain ongoing operations. You've got to make your payroll payments every 2 weeks, so you've got to have cash. So I'm going to start from the bottom and work my way up here. Let's talk about cash flow from financing. So what is cash flow from financing? Well, basically it's saying, did you borrow any money, because that's financing, whether it's short-term or long-term? Did you sell any additional stock, because you can sell chunks of your company in stock? Or did you pay dividends? Now, if you own, or if people own stock in this company, you may wish to pay them dividends, or a portion of these profits, and not retain it all. That's cash flow from financing. So you can see that you could have borrowed or sold stock and made $100,000 and paid $20,000 in dividends and still have $80,000 in cash. So let's go to the next section here. We'll call that a natural cash flow for now. Let's look at cash flow from investing. Well, that comes from, what if I sell a piece of equipment that I'm no longer using here? What if I buy a piece of equipment that I would like? We call it a long-term asset, so I can generate future revenues. Let's just put a number here. Let's just say, for instance, that we bought a piece for $100,000 and I sold a piece. I sold a piece for $100,000 and I purchased one. So you can see if I purchased one, it's going to cost me. If I sold one, I gained it. So in essence, zero here. So the natural cash flow is still showing me that I have $80,000 in cash. Now, here's the real important part. This will take a few minutes to explain the cash flow from operations. This is, did I make sales? I made sales. This would be the sales and inventory that may be ready to sell. I'll just put the word ready here, to sell. Did I have any payables, any expenses? So did I have any possibly accounts payable? Did I have any accrued, big fancy word that I have them but I have not paid them yet, accrued expenses? Or maybe to have some depreciation, because remember, the income statement lecture said that one of these expenses was called depreciation, but it really wasn't a cash expense. I didn't really pay it. So if we go back up here and look at these things, we would understand that if we didn't pay it, we actually have that cash. So depreciation is actually added. Here's a tricky one as well. Here and here, just because I accrued expenses or I owe somebody does not mean I actually paid them in cash, so those would be added as well. So the real tricky one is up here. Did I make sales, and do I have inventory ready to sell? Let's say we'll call this an accounts receivable. Just because somebody says they're going to pay me doesn't mean they have. Just because I have inventory ready doesn't mean I've actually sold it. So I could have sold $10,000 worth of my product. We'll put 10,000 right here. And somebody sent me a piece of paper that says I owe you, but I didn't receive the cash. Therefore, that would be a negative amount. So you can see if I had $80,000 worth of sales, let's just leave the expenses out of the equation here. I didn't actually make any sales. Well, let me take that back. I made the sales. I haven't received the cash. So you can see that would be subtracted from it. So my cash flow from operations would be 0. So it's really important when you look at the cash flow statement is to look at the cash flow from operations. In essence, an accounts receivable is actually subtracted out because you have not received the cash yet. So it becomes very important to make sure that you are getting paid the actual cash. So you can see where management and collecting of accounts receivable is important. What's really confusing is that accounts payable is added back. Depreciation is added. So when I look at this cash flow statement, if I see the cash flow from operations dwindling, I start to ask the question, are we making sales and how long is it taking to collect the actual cash? Because what we're trying to do is reconcile all this so we can figure out right here what has changed. Did cash go up or cash go down? And you can see how if I don't pay much attention to this section up here, that these two bottom sections can dictate cash has flowed in, but those are just natural cash flows. They weren't from the actual job of selling and collecting my cash.